We'll be going over IRS Form 8606, Non-Deductible IRAs. So we did this form in a video a couple years ago, so we're simply updating it to reflect the most recent changes over the past couple of years. There's not a whole lot of new information in this form. Basically, there's a new worksheet for line 15C as well as line 25C. There are some minor adjustments, and of course, the AGI thresholds for Roth IRA contributions has increased. So, other than that, the form's structurally the same as it was a couple years ago. There are several parts to it. I believe there's 3 parts. The first part, and we'll go over each of the parts in this form separately. We'll talk about when you would use each part. So part 1 is non-deductible contributions to traditional IRAs and distributions from traditional SEP, and traditional simple IRAs. Part 2 is 2024 or current year conversions, Roth conversions from traditional SEP or traditional simple IRAs to a Roth SEP, or a Roth simple IRA. And then part 3 is distributions from Roth SEP, or Roth simple IRAs. So you only need to complete the part that's pertinent to the transactions that occurred in your year. And we'll go through each of these separately, one step at a time. Let's start with part 1. Actually, above part 1, you'll complete this form. You can file this separately from your tax return. Specifically in situation, you might do this in situations where you need to update the basis for records keeping purposes. So what you would do is you would fill in the address field only if you're filing this form by itself, not with a tax return. If it's with your tax return, your tax software is probably going to cover the necessary fields up here. So let's just say that John Doe made $5,000 of non-deductible contributions to a traditional IRA. So for the 2024 year, that would also include any contributions made in the following year. So for IRA contribution purposes, you're allowed to contribute up to the original tax filing deadline in the following year. So for 2024, you can actually make that 2024 contribution, or you could all the way through April 15th, 2025. So conversely, 2025 contributions can be made all the way through April 15th, 2026. So let's just say you made $5,000 of non-deductible contributions. So regularly contributions, if you meet the AGI threshold, for folks that participate in a workplace retirement plan, a qualified retirement plan, generally there is an AGI limit. If you don't have a workplace retirement plan, then there is no limit. You can choose to or choose not to make a deductible contribution under those circumstances. If you choose not to make a deductible contribution, this is usually the first step that someone would take towards doing backdoor Roth conversions. Typically, people that might be earning too much money to contribute directly to a Roth IRA, or they're earning too much money and they participate in a workplace retirement plan, so their only contribution choice is a non-deductible IRA contribution. So that's in this case, let's just say that John Doe made $5,000 of non-deductible contributions. In line 2, we're going to add that, or we're going to enter the existing basis. So this, according to the form instructions, you'll generally use 0 if this is your first year that you're required to file IRS Form 8606. If it's not zero, if it's not your first year, there is something known as the total basis chart in your form instructions that will help you determine what your basis is. So if you have only been making non-deductible contributions, your basis will be zero. At any point, your basis will be the amount of your non-deductible contribution, because this is money that you've paid tax to. If your previous contributions were all deductible contributions, then your basis will be zero. Generally speaking, you're going to grab this basis from the prior year basis, which for 2024 taxes, this is the amount that you would carry over from prior years. So again, generally speaking, if you've contributed to an IRA in the past, and you filed IRS Form 8606, there may be a figure different from zero. If you're carrying a figure from prior tax years to the current tax year, then you'll need to look at the total basis line from your most recent Form 8606. And depending on which year your most recent non-deductible contribution was, you may need to look at different lines. Generally speaking, for the past 25 years or so, it's been line 14. So let's just say that he had $10,000 of basis from prior years. You'll add these figures up, and you get $15,000. So now in 2024, it asks you, did you take a distribution from a traditional SEP or traditional simple IRA, or did you make a Roth conversion? So if you did not, then you would simply enter the amount from line 3 onto line 14, and you would just take this amount and put this here. You don't need to complete the rest of this calculation. However, if you did take a distribution from one of those accounts, or if you did make a Roth conversion, then you would need to complete these 10 steps in between. So let's imagine that John Doe's contributions were all in the 2025 tax year. We're going to back that out, and we're going to get the $10,000 of basis back. Now we're going to enter the value of all traditional SEP, and traditional simple IRAs as of the end of the year 2024. So basically, we're going to figure out how much this the basis percentage would be, because when you do distributions, when you do Roth conversions, you pay a prorated amount of tax. So I'm going to make this a little bit simple. So let's just say that we had a $10,000 account balance, and we now have the $10,000 of this basis right here. We're going to enter any distributions from traditional accounts. This would not include rollovers, but there may be certain distribution repayments that are treated as rollovers. For those details, you can either check out the instructions, or you can check out our article. Don't include qualified charitable distributions. Don't include any one-time distributions to fund an HSA, or any Roth conversions, any certain return contributions, or traditional IRA recharacterizations. So let's just say that there were no distributions, but we will kind of go through what this would look like if we did a Roth conversion. Enter the net amount that you converted from a traditional account to a Roth account. Let's just say that he had $10,000 of basis. He has $10,000 of account balances as of December 31st, and he made a $5,000 Roth conversion. We're going to add lines 6, 7, and 8, and we get $15,000. We're now going to take this line 9 amount and we're going to divide line 5 by line 9. And we get 0.667. And now that's the prorated amount. What we're going to do is we're going to multiply line 8 by this amount, and we get something like 3333. This is going to be the amount that we put on line 17. So add lines, in line 12, we're going to multiply line 7 by line 10. Since line 7 was 0, we're going to enter 0. And we're going to add these two up, and we get 3333. Now we're going to subtract this amount from, the line 12 amount from line 7. 0 plus 0 equals 0. Basically, we don't have any basis anymore. Now we're going to subtract line 13 from line 3. I apologize. There's a misstep. So we're going to take the line 13 number, subtract it from line 3, and we get $11,667. Now we're going to subtract the line 12 amount from line 7. That gives us 0. If we had any distributions, which we don't, but if there were any attributable to qualified disaster distributions from reported on IRS Form 8915F, then we would enter that here. As a result, we don't have any of those distributions. So 0 minus 0 equals 0. Again, this is the taxable amount of any distributions. So since we didn't take a distribution, all of these amounts would be 0. Let's change this up a little bit, and let's just say that we did have $2,000 worth of distributions. How would that affect the equation? So let's imagine that we still had a $5,000 Roth conversion. We would add all of this together. So that becomes $17,000. We would then divide this by the 10,000. And I'll have to go offline to do the real quick math, but and for that we get 58.8, I believe, 0.588. And now we would multiply this decimal by the line 5 amount, by the line 8 amount, the $5,000, and we get 2941. We would then multiply line 7 by line 10, and we would get 1176. We now add these two together. And then now we're going to subtract line 13 from line 3, which gives us a slightly different basis amount. So this, I believe, would be 10,853. We're going to subtract the line 12 amount from line 7, and that gives us 824. And if we still didn't have any disaster distributions, then this 824 would become the taxable amount. So in other words, if you have a distribution in the same year as a Roth conversion, they both are used to calculate your basis, which is then used to calculate the taxable versus the non-taxable portion of your Roth conversion, as well as your distribution. So that's what all of this math means, basically separating out the portion that you pay taxes on, the portion that you don't pay taxes on. So this is the taxable amount on distributions. We're going to go to part 2 to determine the taxable amount of the Roth conversion. So if we completed part 1, we're going to take the items from 2 lines, line 8 and line 11. So line 8 is $5,000. We'll use the most recent example. We're not going to reset all of these numbers. So $5,000 and then $29.41. So we're going to bring those two numbers down here. And so just by doing that, you'll see that we had the taxable amount of our distributions calculated in part 1. We still had that question out there as to what part of the Roth conversion was a taxable event, and now we have that amount right here. And this would go on line 4B of this would be included in line 4B of the Form 1040, just like the taxable amount of the distribution would be. So if you look at line 4, generally speaking, it's total IRA distributions. Line 4A would be the total distribution. Line 4B would be the taxable portion. And both the taxable distribution as well as the taxable Roth conversion amounts are included in line 4B. Now, separately, we're going to go to a new topic, which is a distribution from a Roth or a simple IRA, Roth account, whether it's a Roth IRA, Roth SEP, or a Roth Simple. So basically, we're going to take any the total non-qualified distributions. So the non-qualified distributions technically consist of all of those early distributions. What they don't include would be any rollover distribution or like distributions that you rolled over. So anything that was rolled over after the end of the prior year, any recharacterizations, any return of contributions, any distributions that were made after you turn age 59 and a half. If you made a contribution at any point between 1998 and 2019. So one of the rules about Roth IRAs is that you have to have an account where you made a contribution at least 5 years prior before. So you don't include that as part of your non-qualified distribution. Once you've had a Roth IRA open for 5 years and the money that you contributed has been in that account, that is considered qualified, at least from a distribution perspective, as long as you meet the age requirement anytime after reaching age 59 and a half, or if you have an early withdrawal exception. Don't include any one-time distributions that are used to fund an HSA. Don't use qualified charitable distributions, which shouldn't be coming out of a Roth account in the first place. Don't include any distributions that were made either upon death or due to disability if the contribution was made at least 5 years prior. Don't include any qualified distributions reported on Part 4 of your Form 8915. And don't include any distributions that would be incident to a divorce. So distributions that are incident to a divorce are considered qualified, as long as it's part of the divorce decree. So let's say that we have $10,000 in non-qualified distributions. Now, you can exempt any first-time home buyer expenses up to an amount of $10,000. So you can't. So if you took this $10,000 out because it was a first-time home purchase, and then you would have zero. Let's just say that you didn't, and all of this was an actual non-qualified distribution, and there's no early withdrawal exception or anything like that. So if this were zero, then you would enter your basis, and then that's it. So because we have $10,000 here, we are going to enter our basis. And the basis, you would need to um, refer to the form instructions or our article. Basically, there is an offline worksheet that discusses if you took a distribution before the tax year, there may be an adjustment in your basis. So you would need to go through that to determine what the actual number to put in here would be. Let's just say that our basis was $10,000. And so this amount would be zero. If it's zero or less, you can skip line 24 and line 25. Then that would be it. Basically, what you're saying is it was a non-qualified distribution, but technically my basis was the same amount, so it's okay. So the basis, there are a couple of examples where you would increase your basis. So in the article, we kind of go into detail. One of the examples would be service member group life insurance proceeds to a qualified beneficiary that was rolled over into a Roth IRA. That automatically increases the basis by whatever amount of the proceeds were contributed to here. So any contribution, you would increase or decrease based on any amounts received or transferred based on a divorce, any amount rolled in from another Roth account. So all of those items would be adjustments to basis. So if you have basis here that exceeds the amount of your distributions, then you're not going to pay tax on that. Let's just say that the basis was zero. So now we have $10,000 of a non-qualified distribution, and we got to figure out what to do with. Now, in line 24, we're going to enter the basis on any Roth conversions. So if you never made a Roth conversion, the basis would be zero. But if we had, say, $5,000 of basis from prior Roth conversions, then we're going to do kind of a similar calculation. Basically, the $5,000 of basis, we're going to first subtract any qualified disaster distributions from that amount. So since we don't have that, this entire $5,000 is a taxable amount. So to paraphrase part 3 and all the calculation we just went through, we had a $10,000 non-qualified distribution. We had $5,000 of basis, which means that the additional $5,000 of our withdrawal, since it didn't get mitigated by any qualified disaster distributions, it's all taxable. That would also be reported on line 4B. Yes, this would be a distribution from a Roth IRA. Again, most people who have had a Roth IRA for greater than 5 years that are pulling out money that's been in there for at least 5 years and who are either 59 and a half or meet one of the early withdrawal exceptions, all of this is going to be, it's going to result in zeros. But the part 3 portion still exists for people that are either withdrawing in excess of their basis if they're making non-qualified distributions. Of course, if your total non-qualified distributions is zero because all of your distributions are qualified, then generally speaking, this is going to be what it looks like. You'll have a basis in here, and then everything else will be zeros. So that's what it would look like under normal circumstances from a Roth withdrawal. And then, of course, there's a signature page. You would sign it. If you have a tax preparer, they would sign it, date it. So again, this can be done independently of a tax return. That would be mostly for basis adjustments or reporting basis to make sure that it's included for future calculations. So I think that covers everything. We have recently updated our article, so please check it out. We'll put the link in the show notes. And if there are any articles or if there are any forms mentioned here, you can research those. We'll put links in the show notes, or you can go to teachmepersonalfinance.com, type in the name of the form that you're looking for, and it should pop right up in the search results. So if you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. And as always, if you have any questions, comments, or if there's another topic that you'd like to see covered in an upcoming video, please hit me up in the comment section. Thank you very much and have a great day.